Hi, and welcome back to MBA in a Box. In this lesson, we will start talking about the last phase of the industry lifecycle model, the decline phase. First, however, I would like to ask you a favor. I would be really grateful if you go to the course dashboard. That's easy to do. All you have to do is click here and leave a rating for the course. This will mean a lot to me and will help other students know that this course is worth taking. The reason I'm asking you to do this now is that this is a large course and most people do not complete all the lessons in one sitting, eventually forgetting to leave a rating. So please do it now. It should only take you a couple of seconds and it will really validate our efforts. Thank you so much for this. Okay, now, having said that, let's continue with our topic, the industry lifecycle model and its decline phase. Naturally, the last phase we'll examine in more detail is the decline phase. It is characterized by an absolute decrease of sales for at least 3 or more years. Customers abandon the market due to changing tastes or an emerging new industry. In the decline phase, the pie doesn't expand, it becomes smaller. Companies that used to sell 100,000 units of a product in a calendar year must deal with a situation when they sell 70,000 and less. Obviously, there will be overcapacity in the industry, because firms have invested in plants that can produce 100,000 units per year. These plants are not used to their fullest potential, which increases unitary costs and drives down profitability. To sell more units, some businesses will be tempted to discount heavily and slash their prices, which will lead to negative margins for companies with inefficient cost structures. They will likely be the first to abandon the market. Other companies will abandon the market too, as they will probably prefer to prioritize a new industry, which is promising in terms of growth potential. There are 4 main ways to deal with the decline phase. A company may abandon the market completely and disinvest its assets as fast as possible. Or it may adopt the so-called harvesting strategy, which is the most popular approach used by managers. The harvesting strategy consists of reducing investments and expenditures, no R&D, no marketing expenses, no investments in capex, and so on, and focusing on cash flow generation. This isn't a bad strategy. Alternatively, it can decide to be bold and win a market everyone else is quitting. If it does that, it will gain other companies' marketing share and become a market leader. This is typically done by making a substantial investment in, let's say, marketing, when everyone else is harvesting. Other companies will be unwilling to respond and will probably prefer to abandon the market. The 4th way to address industry decline is by continuing the execution of a niche strategy. More on that in one of our next chapters. Most of you probably do not even remember vinyl records, but they were popular a few decades ago. However, the invention of compact cassettes and then CDs led to the decline of the industry. This doesn't mean the entire vinyl industry ended instantly. Even when an industry is in decline, some companies operate and do well. Such is the case with the Czech company GZ Media, which embraced the opportunity and became the world's largest vinyl producer. Its sales figures continued to grow in 2014, 2015, and 2016. The company achieved a 40% year-on-year growth of revenues between 2014 and 2015, selling 25 million records. GZ Media's ability to win in a declining market proves abandonment isn't the only viable options for managers at this final stage of development.